Hello all, my name is Vajiradi Alves. This presentation is created for the accounting and financial systems. As a part of this subject, we have to do a presentation uh, about understanding financial systems of an organization. So I choose one of the famous companies in Australia called WESFARMERS. In this presentation, I'm going to talk about the company history, location, what products and brands they offer, size of the company and its operations. Secondly, their financial position. Then, in the third section of the presentation, I'm going to discuss about the Wesfarmers balance sheet, income statement, and cash flow, how it affects on specific stakeholders, identifying key assets, liabilities, equity classes of the Wesfarmers, and what is the most impacting factor on their financial performance. Also discussed in this presentation. At the last section of the presentation, I'm going to do a in-depth analysis of the Wesfarmers using relevant ratios. In that one, I'm going to do a horizontal and vertical analysis, and I'm going to talk about the firm's profitability, liquidity, solvency, and efficiency. Okay, let's move on. About Wesfarmers. The Wesfarmers, known as one of the largest private organizations in Australia, spanning business over Australia and New Zealand. When we're talking about the history, the company has started in 1914 by a group group of Western Australian farmers, and the company headquarters located in Western Australia. The company spread its operation towards different areas such as supermarkets, department stores, coal and mining, office supplies, chemicals, energy, fertilizers, and industrial safety products. If you're talking about the company, Wesfarmers is one of the Australia's largest private sector employees, 220,000 employees, and shareholder base approximately 530,000. So when you're talking about the company, Wesfarmers give a significant contribution to the Australian economy. As you can see on this finance performance overview of the Wesfarmers, the Wesfarmers generated revenue 66 billion in 2016 financial year. Out of that 66 billion, they paid the payments to its suppliers 45.5 billion, then 13.8 billion for the value distribution. Under that value distribution, 8.4 billion dollars in employee salaries and wages and other benefits, 1.5 billion government taxes and royalties, 0.3 billion to its lenders, 2.1 billion to the shareholders in dividends and investments. Then they invested 1.5 billion reinvested in the business, and out of 66 billion, 6.7 billion they paid in rent and other operational expenses. In talking about the financial position of the Wesfarmers, as you can see, their highest recorded $42.10, the highest share value. Then the lowest share value is $41.72, and they opened the share market price of $41.73. So if you're talking about the share value, so it doesn't go much like go under or over. When you look at the share prices, so companies doing average at the moment. When you're talking about the balance sheet, income statement and the cash flow of the Wesfarmers, current ratio was 0.92, and the quick ratio was 0.21, which doesn't look good on the Wesfarmers, and especially on its stakeholders, like when you're talking about especially on the suppliers, like when the quick ratio is getting closer to 1, means the company is performing really good. Then the suppliers have a look on their quick ratio, then they maybe put different conditions, or they give discounts when the quick ratio is good. As you can see in Wesfarmers figures, their 2014 ratio was 0.45, then 2015 0.26, and 0.21 in 2016. So that you can see keep decreasing. So in future they may be facing difficulties gaining credits from its suppliers. Explaining with an example, the Goodfinfield bakeries. So they are the people who supply bakery items to the uh, cold supermarkets. So when they looking at the quick ratio of the Wesfarmers, they maybe put some conditions on their credit. So that's a bit of a concern the company needs to look at. And the key assets, liabilities, and equity classes, and income and expenses of the Wesfarmers. So as you can see, Wesfarmers has key assets of total inventory value worth 7,189.2 million. Current assets, and they recorded their goodwill and the other intangible assets worth of 14,159 million in 2016. When you're talking about the liability, Wesfarmers current debt and capital lease obligation of 1,211 million, and total payable value is 4,818 million. Equity classes, the key equity class of the Wesfarmers is common stock, retained earning of 17,545 million, stockholders equity 17,037 in 2017 financial year. And this is the most important factor of the Wesfarmers. Their expenses significantly reduced over last 3 years, especially 5 years. So their operating expenses in 2016 is 14,090.6 million. So they really perform well in this section, because they highlighted that they invested more on technologies, such as, if you get an example, they invested much more money in the technological aspects, such as investing money on the self checkouts, so that reduce the operational costs, reduce the labor, and they introduce SAP and other advanced technologies on their business. So which is a good good outlook on the company. The operating profit margin of the Wesfarmers in 2016 was 1.58, which considered as negative impact on the Wesfarmers, because it directly impacts on it both internal and external stakeholders. Wesfarmers record the lowest in 2016 compared to last 2 years, which suppliers may put conditions on the credit, as I mentioned before. Then when we talk about the managerial judgment, this managerial in accounting convention, maintaining accurate information regarding the debtors and depreciation rate gives positive outlook on the managerial judgment of the company. In regards to the Wesfarmers, accumulated depreciation in 2016 was 6,293 million comparing to the last 2 financial years. It's increased by 1,246 million, which they followed the fair value convention. In the fair value convention, managers decide depreciation based on the current value assets, which give more percentage compared to the last financial years. Another fact is managers and accountants present the figures free from bias, which didn't assume any figures. They analyzed the key financial data and which are relevant and current and present in the financial statement. And if you're talking about the data to the Wesfarmers, this considered as an asset. So if you keep that data in the company, so good customers mainly, if you give some discounts to the good customers and they giving extended time periods to pay, which is a significant benefits of to the customers, then the customers stay with the company. Moving towards the last section of the presentation, financial position, performance, and of the Wesfarmers. As you can see, 2016 financial statement revealed that the profit margin of in the Wesfarmers was 0.62, which means every dollar of the sales generate of the operating profit. In talking about the other definition, 99.35 of the sales revenue used to cover the running cost. When we comparing vertical analysis, profit margins start to decrease from 2015 and 16. This appeared to be negative impact on the Wesfarmers, and the company needs to focus more on their capital structure. Important to increase equity capital more than debt, which will reduce interest on payments on the debt. On the other hand, return on equity for the investor in the Wesfarmers was 3.01%, which means every dollar of equity invested Wesfarmers generating net profit of 3.01% in 2016. When we compare with 2015 figure, it was 39%, decrease compared to 2016. Based on the last year figures, the management can predict and expect another lowest in 2017 if they follow the same strategy within the organization. Current strategy, based on the ratios, current strategy may face difficulties gaining credits from its suppliers in the future. In the horizontal analysis of the Wesfarmers, I took as an example Woolworths. That's also another massive group of companies that consist of department stores and liquor business and supermarkets. So taking closer look at the Woolworths, record highest turnover 2.39 compared to the Wesfarmers 1.61 in 2016. Comparing with the last 5 years, Woolworths able to manage 2.46 and 2.62 and 2.68 respectively last 5 years. So I got this data from the OneSource website. According to the analysis, it's proven that Woolworths deploying its assets and generating revenue more effectively and efficiently than the Wesfarmers. Based on the ratio analysis, liquidity ratio emphasis that the company's ability to meet its financial obligation. So in conclusion, analyzing both Woolworths and Wesfarmers last 2 financial years, they face a lot of difficulties, especially Woolworths, because the Masters home improvement chain, they had to shut down, and that joint venture left out of the Woolworths group. So that did give like a bit of a collapse on the company. And solvency, that means enterprise ability to meet its debts and other obligation. In this indicate company cash flow sufficient for short term and long term liabilities. Comparing with the Woolworths, 0.51 in 2016 and 0.64 in 2015 of the Wesfarmers highlighted both companies not taking advantages of increased profits during that financial year 2016, which leverage occurs in this financial year. In conclusion, I would like to give a recommendation to the Woolworths and the West Farmers, they need to keep their quick ratios getting closer to 1, which will give significant benefit to the company, especially gaining credits from the suppliers. And the other one is they need to more focus on their operational expenses that reduce the operation costs, so which will give significant benefits to the company. That's all about my presentation. Thank you for listening.